Hi everyone, welcome back to Atrium Research's YouTube channel. Today I have the pleasure of interviewing Ghassan Halazon, the founder and CEO of Emerge Commerce, which trades under the ticker ECOM on the TSX Venture. ECOM has had a major turnaround over the last couple quarters, posting very strong revenue growth as well as newfound profitability. So thanks for being here, Ghassan.
Thank you so much, Nick. Appreciate all you guys do for the world of small cap. So I'm going to jump right into the presentation, and let me just spend a moment on my background. For the past 15 years or so, all I've been doing is building, buying, selling, restructuring e-commerce companies for a living. So you name it, we've probably been through it. With Emerge specifically, we've gone through a few iterations of the model, and we feel like we've landed finally on a playbook and a platform that is primed for scaling, and we're doing so profitably and with positive cash flow. So without further ado, I'm going to jump right into what we're about. Emerge Commerce is a Canadian portfolio of premium brands across grocery and golf verticals. We are focused on the Canadian market. We also have a US presence. Emerge is on a $27 million revenue run rate, pro forma with our most recent acquisition. We target about a 40% gross margin for the business, and we've been around there. We've been positive EBITDA for the past couple of quarters at an increasing clip, as you'll see. And all in all, we have about 4 brands across 2 verticals, being grocery and golf. So just a bit of a peek on our Q2 results, because they were eye-opening for many, and that's sort of been the awakening for most to pay attention to ecom again. Revenue grew 70% plus to 8.5 million. We had an adjusted EBITDA swing, and a positive one at that, for about $1 million year over year. Our cash grew as well, both quarter over quarter and year over year, sitting at about $3.5 million. Not on here, but worth noting that our cash flow from operations was north of $2 million in Q2 alone, and we stood at about $1.5 million in cash flow from operations year to date. So a bit about our key brands. True Local is our flagship grocery brand. We are the #1 player in Canada for meat and seafood subscription, straight from local farmers, delivered to our customers in the what we call direct-to-consumer model, D2C for short. We at True Local are having a banner year with the Support Local movement and the Buy Canadian sentiment that's sweeping the country. We think that this is a model that has blue sky potential. If we look south of the border, Butcher Box is a hidden gem. Many know it as well in e-commerce, at least. It's a $500 million revenue business, notably bootstrapped from the ground up. And we are the Butcher Box of Canada. Effectively, we're the market leader here. This business is at about just under 16 million in revenue. We think this is a north of $100 million opportunity, both organically and inorganically. Moving to the golf side of the business, we have 3 brands, inclusive of our most recent acquisition, and it is also our most profitable business, Tee 2 Green. This is one of those quote-unquote old-school cash flow boring businesses. It has a 38-year-old track record. It sells golf apparel and equipment. It does so mostly offline, at road shows or pop-up stores, as well as a couple of retail stores exclusively in Ontario for the most part. We were able to drive growth with Tee 2 Green, as you'll see shortly, through our golf portfolio. We have 400,000 golf members. We have a golf marketplace for equipment and apparel called Just Golf Stuff, which notably has grown 10x over the last 5 years since acquiring it in 2019. We work with different brands. This is the sort of the Callaways, the Adidases, the Pumas, and importantly, we are focused in the discount golf space. So we don't do anything full price. We're not involved in this year's models. This is more like come grab clearance, get big deals on prior years. And UnderPar is really the market leader in golf tee times and experiences, also in the discounted category. This was a business actually that suffered when golf got very popular during the pandemic. But as the economy has weakened and as more events and travel have opened up, this is a model that's now back on the rise. And I should have mentioned both our verticals are growing organically and both are profitable. So a little bit about our T2Green acquisition, which changed the game for us back in April of this year. As I mentioned, this is a profitable business, does about $1 million in EBITDA and 6 million plus in revenue last year. We were very fortunate to land a very opportunistic and reasonable deal for Emerge. We paid less than 2.5 times EBITDA on the overall deal. We got 5-year deferred payment terms. We also got 8 years on the inventory for a payment plan. And that's pretty much unheard of terms, at least from what we've seen and been around. So we were fortunate to do so. It was a succession situation, retirement situation, the type of thing that you read about in the papers around sort of some of the dilemmas and really the sweetheart deals available in that sort of situation. The idea of us acquiring it made a lot of sense synergistically with our portfolio. We have an audience, we have more scale together, we can leverage our data, our marketing, and get volume discounts. So let's put the theory to the test. This was a really exciting milestone for Emerge. The first quarter of T2Green under Emerge, historically, by the way, a flat to minimal growth business, we were able to catapult its revenue by 31% in its first quarter under Emerge to 3.3 million, and adjusted EBITDA close to 800K in Q2. Mind you, that was golf season launching, and it is a seasonal business, but still, we're very happy to see these results, both top line and bottom line. And the sort of headline in the end is that this was an absolute home run quarter. We recouped our 1.1 million upfront cash investment, which we funded, by the way, from our cash flow. We didn't have to raise any capital to do this deal, but we were able to recoup that capital in less than 90 days. And our cash is actually sitting at higher than where we were right before this deal. So I just want to sort of touch on briefly where we've come from. For those of you who don't know Emerge or ECOM, it actually has been quite the journey, quite painful along the way. A lot of valuable lessons that we've learned and have poured into this new playbook. But once upon a time, Emerge was a diversified portfolio designed to be a constellation software of e-commerce, if you will, i.e. we wanted to be a diversified, decentralized, low synergy portfolio. And that thesis, unfortunately for us and many others, failed. It was a broken model, right? There were no synergies. Debt was too high for us. Our leverage was high for years. We've really made a dent into that. We've paid off 80% of our debt over the last couple of years, with still some more work to do. And we were in turnaround mode in the middle there in that 2.0 chapter, where all we did was focus inwards, reignite our growth, sell non-core businesses to pay down debt, and obviously wait for an improving macro as well, which we're starting to see now with the lower rate cuts or the increased rate cuts. And then finally, sort of the 3.0 chapter, which is where we are today and why we're out here starting to speak to folks in a more methodical approach, is the fact that we've stumbled on this situation where the current portfolio, the streamlined strategy here with grocery on the one end and golf on the other, the two verticals we know best and started off with, we're finding great success both organically, where we've accelerated these businesses. We're on track to do 6 quarters in a row of organic revenue growth, multiple quarters in a row of EBITDA growth, and now cash flow positive. All of this also means that we think there's more opportunities to get cheaper, longer term debt. These are the types of businesses we're looking to acquire from here. So we're exclusively focused on grocery and golf. But we really want to do so in a very disciplined way with track record, profit or cash flow on day one or year one, if you will. They don't need to be growing too fast, but they do need to be stable. We're not looking at more turnarounds. That's way too much work. We've done it the right way with Emerge, but that's a lot of work. We'd rather buy stuff that's working and accelerate it, as we did with T to Green. This is the grand vision right now. 2 verticals, 2 $100 million opportunities. We want to acquire competitors in our space. We want to acquire vertically integrated type companies that help the value prop of both grocery and golf. We have 2 terrific starting points with the flagship brand, market leader with True Local on the premium meat and seafood side. We also have a 3-brand, 400,000 portfolio in the golf space. We have about 14 target acquisition opportunities that we outlined. And of course, we have more than that in the background being cultivated. If you're wondering what we do when we acquire stuff, this is a slide. It's kind of on the boring side of things, but again, that's boring is brilliant, we like to say. These are the exact type of synergies and service combinations that we're doing in the background to find additional savings. A lot of companies bring this stuff up, but the reason Emerge turned from negative EBITDA to positive EBITDA and negative cash flow to positive cash flow is because a lot of the things here, and of course, the reason we've been able to grow now for almost 2 years in a row is a lot of the growth aspects down here as well. This is the team. In addition to myself having been in e-commerce and in capital markets before that, I used to work at Wall Street in New York with Citi. I did my MBA at Georgetown in DC. Morris Finn is a fantastic operator. He heads up our golf division. I've known him for the better part of 15 years. And he's done a phenomenal job leading golf, while I focus on the holding company and the public company, as well as True Local, where I spend most of my time. I'd like to also highlight Ian McKinnon, who was on the board of Constellation Software for 12 years with Mark Leonard and company. What an adventure that was, and tens of billions of dollars of shareholder value created. He's been a terrific mentor to myself and to the team. And John Kim actually is on the board of Well Health, which is also another notable billion-dollar plus roll-up in health tech. Drew Green is the chairman, and he is the president and CEO of Indochino, a custom apparel company that's a leader in that space. In terms of the cap table, we're sitting at about 8.5 cents, so about less than a $13 million market cap. We have 150 million shares outstanding. We basically have about 7 million plus in debt between the senior facility, 5.85, and the convertible note of about 1.4. We also have 3.5 million in cash. So our net debt position is sub 4 million between those two, about 4 to 5 million if you add some of the deferred payments owed to brands as well. And I'll just close out here just in terms of sort of the big picture again, just to outline with Emerge. We have a track record here of not only turning around the company and cleaning it up, but actually accelerating it, growing it, making it profitable, making it cash flow positive. We're fortunate that our model has great tailwinds, both on the True Local side because of the support local movement and the eat healthy sort of trends and convenience. Delivery is a big part of this as well. But then on the golf side, we're also seeing great traction because of the weakening economy and our leading brands as well. So we actually are uniquely positioned in a time of general macro uncertainty to actually thrive. And then in terms of like our leverage, we've reduced that. Happy to chat about that more. But high level, we've reduced it by 80%. We had a 32 million net debt position years back. We're closer to the 4 to 5 million range, depending on how you calculate it now. And we have a team that shows been through it all, been through the scars, been through the war stories, and has never quit, is back, is growing, and is excited about this next phase to go out and acquire $1 to $2 million EBITDA opportunities exclusively in areas we're already winning at, being grocery, golf. That is sort of the outline of it all. There's $200 million opportunities that we're very excited about pursuing, and that is what we're going to do. That's it. That's the conclusion of the presentation. Tried to keep it tight for your audience, and happy to answer any questions you have.
Awesome. Well, yeah, that was a great overview. Appreciate that. So yeah, a couple questions here. So firstly, for those unfamiliar, maybe tell us a bit more about the history, because you guys were in a bunch of different industries, but now focused in on golf and then meat and seafood.
Yeah, totally. So as I had mentioned, we once upon a time were a one-stop shop for all of these e-commerce verticals categories. We were in pets, outdoor gear, travel, in addition to grocery and golf, which was our original DNA. What we found, Nick, was that going broad in e-commerce doesn't quite work well. In fact, it doesn't work at all. In software holding companies or boring business holding companies, it kind of works because a lot of those businesses are very sticky, and there's low churn. Unlike in consumer, where you have to build a real brand, you have to stand out with the community, and that is why we said instead of going broad, let's with this new ecom chapter go narrow and specific and focused. So True Local is not just any brand; it is the face of Canadian food tech, specifically for meat and seafood, and where we're winning big. And as I said, where there's a huge multi-$100 million opportunity if you look south of the border with someone like a Butcher Box, who is not in Canada. We're number one here, and we want to pursue more focus. And with that focus allows us to, again, double down on higher ROI opportunities, and at the same time with the golf, leverage the three brand portfolio for more synergies.
Great. Okay. Appreciate that. And then shifting over to the balance sheet, I think you said about 80% of the debt has been reduced over the last few years. So are you guys comfortable with the current balance sheet, and how do you see that playing out over the next year?
Yeah, I think as with any shrewd operators, I think that the focus to always continuously improve the balance sheet should be top of mind. There's always room to grow and improve. I love the quote from Warren Buffett, or at least something that he said recently in one of his annual meetings, is that he looks at a balance sheet first. And we had a lot of work to do on the balance sheet, a few years ago, and we made some tough decisions. We sold non-core businesses to pay down the debt. I do think that if you look at our track record in the last couple of years, you've been able to grow with this balance sheet that we have. So it hasn't prevented us from growing. It hasn't prevented us from cash flowing better. And I think that we've eliminated 80% of the debt, but where we want to be more opportune is potentially get a lower cost of capital for whatever debt we have left.
Okay, that makes sense. And then what does the profitability look like going forward? Or is the last couple of quarters representative of what we should expect?
Yeah, I think you got to keep in mind our business is somewhat seasonal, and it's not seasonal all the time at the same time. In other words, golf is seasonal in different ways than meat and seafood subscription to some extent. Overall, though, what I would say is a good way to think of our business model moving forward on a combined basis is that I think we're probably in that 5.5 to 6.5 range for EBITDA margins. Probably gross margins of 40% is the target. And I think as we add more scale, you can start seeing that EBITDA margin peak up to 7.5, 8, even 9%. And I think the holy grail ultimately is to get to, once you get to north of 100 million in revenue, so we're sitting at about one third that now, or with some expected growth coming in. I think once you get to that, you can start aiming for closer to 10 to 12% EBITDA margins, sort of longer term. I think is a healthy place to be. But as an omni-channel, and we are now not just e-commerce, we are offline as well with the addition of Tee to Green, and we're certainly going to be more open to other cash flow acquisition types like that. I think kind of that 6 to 7% band is a good short to medium term target, and then start approaching the 9-10% with a bit more scale.
Right. Yep, that makes sense. And then on the top line growth, it's been really solid the last couple quarters. What has been driving that, particularly for both sides of the business?
Right. So at a high level, I mean, the business has been on a positive organic growth trajectory for about 2 years now, and so 2025 will be the second year in a row there. But I think more recently, what's driven the accelerated growth is really the remarkable success we're having here in the early going with Tee to Green. We took a boring, flat business traditionally, and we've been able to propel it to 30% growth. And the way we've done that is we almost have an unfair advantage, Nick. We took this business, its customers, its merchants, and we were able to supercharge it with our advertising and our data and our golf, specifically our golf strategies for marketing, which we've amassed over the last 7-8 years of being with Underpar and e-commerce in general. And so what we were able to see is that taking these demographics and connecting them with shows that might be of interest to them, or with other people that they might want to go to the show with through Facebook, through Google, through influencers. That's been very successful for us. I think that as we become a bigger growth by acquisition company again, I would say that our number one goal isn't to have crazy organic growth. We had 70% total growth, but our organic was, double digits, but on the lower end, kind of call it between 10 and 15% organic. So I would start saying that as we acquire more companies, that, we are fine with that sort of 10 to 15%, maybe 20% organic growth level, but then the higher growth is going to come from acquisition so that we can be 50 to 100% up overall.
Okay. Yep. Got it. And then lastly, on the acquisition front, a couple questions. So firstly, how do you guys go about financing these acquisitions? And then secondly, why do you think this round of acquisitions will be different than what you guys did in the past, where you had to do some divestitures and it didn't work out so well?
Right. It's a very fair question. It's a very important one. It's interesting, having been in the space for 15 years, we almost know all the different key competitors or potential strategic partners. We know them personally. We have relationships built. There's a lot of time invested in getting to know the spaces. And now that we're in grocery and golf, we certainly are around, tens, if not hundreds, of groups that specialize in the things we're interested in going after, whether that's a competitor, whether that's someone that can, strengthen the pie. So a lot of it is relationship building. Yeah, we're open to brokers and third parties, and we do a little bit of that. But a lot of the best deals that we've seen, they've come through us directly building relationships, in some cases for many years. So that's one. That's how we access these deals. And I should say this, we are not looking to do 10 deals a year, by the way. T2 Green was transformative. If we can do another great deal in the next couple of quarters, that would be awesome, right? But I will say too that it has to be the right deal. Like the beauty of this part or this phase is that, something like a T2 Green was very, very opportunistic and structured exactly the way the doctor ordered, for us to kind of gain from it the way we're gaining from it right now. We want to be that acquirer. We're not here to just promise 7 deals a year and, every quarter, whether it's a good deal or a bad deal, we're just going to go. Yeah, that was kind of the mood last time around when things were crazy. A lot of money was thrown on us. And it was the peak of the pandemic, and that's really the reason. If I were to narrow down what didn't work last playbook, I would say there's 3 or 4 things. One was, again, the eagerness of everyone around us, including myself, to go out and acquire and get scale. We got to 120 million, so it's not like we didn't build scale, and we had 4 or 5 million in EBITDA at the peak. But unfortunately, that doesn't mean much if you have that much more in debt and all your businesses are organically declining because the pandemic reversal happened. All of e-commerce shot up and then all of e-commerce came down. And that's not anyone's fault. There were many different operators operating our businesses. CEOs of every single company of ours was declining. Interest rates were going up. So we basically had the perfect storm, and we had no synergy. Right? We had no synergy. So compare that to where we are now. We're only buying stuff that's synergistic, that we can drive and organically grow. This is the HQ team operating these businesses between myself and the head of golf and our department of analytics and digital ads and finance. And so we have a much better handle, and we're back to our basics. We're back to the DNA that we did very well at to begin with, that took us to the public markets. When we went broad and when we went fast to acquire all sorts of companies is really when we ran into trouble, especially with the macro being so difficult on us in the reversal of the pandemic, which we have no such issue here. In fact, if anything, I don't know when you're going to air this video, but we had another rate cut today, and we think that all of that is very, very positive for Emerge.
Yeah, absolutely. And on the financing side, you guys think you're going to take on more debt to do this, or drum up some more cash flow over the next couple of quarters?
Right. So very, very important question, and a key thing for me to articulate clearly to folks either hearing this for the first time or getting reacquainted with us, as many are these days. Emerge traded over 20 million in volume last couple of months, almost 10x what we saw prior year. So we're very fortunate to get the attention. So I want to make this very clear, like, we are not going to be making those same mistakes. We are not adding more debt. If anything, we're looking at opportunities to reduce our current cost of capital. In other words, the interest rate we're getting now, we believe, is no longer commensurate with the level of profitability and the level of the business overall. We deserve cheaper, longer term cost of capital. And I've been clear in our Q2 earnings call that this is one of the key catalysts that we view for Emerge, or sort of one of the key levers. One is continue to operate with discipline, drive that double-digit organic growth. Two, layer on accretive discipline acquisitions in our areas of competency, meaning in grocery and golf. And then three, find that cheaper, longer term cost of capital. But to be abundantly clear, we're talking about not taking on more debt, but just making the current debt cheaper and maybe potentially reducing it as time goes as a percent of our overall EBITDA.
Yeah, that makes sense and that's clear. So appreciate that. Those were the only questions I had. So appreciate you walking us through the deck and answering the questions and giving us some more clarity on the story. I think it's going to be very exciting to see over the next couple quarters here, with the growth that you guys have and a lot of the catalysts that are happening. So again, thanks for the time, Ghassan.
Thank you so much, Nick. I'm a fan of your work and everything you do to bring names like ours to the forefront, and hopefully your investors give us a shot and get to learn more, and we look forward to sharing our progress as we go.
Appreciate the kind words. Thanks, everybody.
Thank you.